let's start by talking about what's on everyone's mind, macro. So today, as you guys saw, the inflation print was 8.3%. We have a developing energy crisis in Europe, and there's been a significant slowdown in hiring. So what are the events and trends that you guys are going to be paying attention to over the next 12 to 18 months, and why? So Everett, let's start with you.
Sure. Sounds great. Hey, everybody. I'm Everett Cook. I'm CEO and co-founder at Row. Thank you for joining us here today. Before starting Row, I was a macro portfolio manager at several hedge funds, including Point 72 Capital, where I was an analyst. But I spent a lot of time thinking about this stuff, and when I'm building Row, we're always conscious about like how we're building into the future and what that future is going to look like. We as a financial services company, as a fintech company, we pay a lot of attention to this. I think that and it's important to have a lot of perspective, I think. And that's the hardest thing as an investor and as a founder, is to try to zoom out. It's really easy to get stuck in the day-to-day, like the market's down 5% today. The print was 0.1% worse than expected, which seems like a lot. But, we're also back to where we were Tuesday, so I don't know. But zooming out, like big picture, we're in a process of normalization, right? And like last year was very weird for a lot of reasons. But if you look at everything else, you had a supply shock that created like a significant pressure point on inflation, which pushed us to where we are today. We're normalizing. Real rates are at like roughly back to where they were at least real tens, like back to roughly where they were, in the 2013, 2020 cycle. And tech valuations overshot to the upside, probably are overshooting to the downside. So I think it's easy to get stuck in the hysteria. It's easy to get sucked into freaking out about all these risks that are, by the way, like fairly known. Like these are things that we're talking about. These aren't black swan events, and lose sight of the long term. And that's kind of why I started a company too, was because and as advisors, as investors, your clients are investing with you for the long term, and that's really like what, in the long term, like we are kind of coming back to normal. It's not a crisis, in my opinion.
Latif, what do you think about that?
Yeah, I mean, I would agree. As a VC investor, my time horizon is very, very long, so I'm not totally paying too much attention to the next 12 months, other than, of course, want rates to stop going up, want inflation to come down a bit more. That's good for the markets overall. But, my job is to invest in, what are really, really big markets over the next 10 years, 15 years. Financial services, where Everett is building, it's like nearly 10% of GDP. 20 trillion globally goes through the system every year, and it's clear that software is going to be making financial services better for for SMBs, for individuals across the board, and we still think we're in the very, very early innings of that revolution. And so pay attention to it because it's important for multiples and things like that, but really, our role is to find really, really big markets and folks like Everett who are really disrupting those big markets.
Yeah, so that makes sense what you guys are thinking about, as business owners, as, venture capitalists. So there's a lot of, business owners here in the audience, advisors, given what's happening in the macro economy, what should they be thinking about in terms of their tech strategy, like going forward, given all this information?
Yeah, I think it's a couple things. So first of all, and I apologize, I forgot to introduce what we do. So Row is a fintech platform. We are a finance automation platform. So we work with companies, generally like 10 million to $1 billion in revenue, and we are their commercial banking platform, their corporate card, their expense management, their AP platform. They sound like a lot of things. They're actually just one thing, which is kind of moving and managing money. And for any of you that that have to deal with that on a day-to-day basis, how painful that is. How and every CFO almost that we see, is juggling 5, 7 of these products, spending a ton of money on them, and more importantly, wasting a ton of time dealing with them. So for us, what we deliver is control. We deliver control over companies' money, and so we deliver control to CFOs. And that right now, for the companies that we serve, and for all of you that are business owners, couldn't be more important, right? Like everybody is watching every dollar, and so it's really critical that we deliver on our promise, and that we continue to make this sort of better, and also reducing costs for these companies, and that's fundamentally what we're delivering. So as companies think about their tech strategy, as you guys think about your tech strategy as a business owner, we always believe like value your time over money. Like save both, but put your time first, because that's the most valuable asset, and look at like newer products like ours that help you do that.
Yeah, I mean, the only thing I'd add, if you look at Row, and we led the Series A in the business a couple of years back. It's kind of odd if you think about it that you've got a bank account with J.P. Morgan or First Republic or whoever. You do your payments through Bill.com. You do your expenses through Expensify. Like, it doesn't make sense. It didn't make sense to us, or whatever.
And you guys were doing that.
Whatever it made very clear was like, hey, like, why isn't there one place to do all these things? Imagine if you could provide services to business owners that, if you knew what was going on with their bank accounts and you knew how they were spending their money, you could offer them really personalized, really amazing products. And that was a really big aha moment for us, because if you think about the stickiness of a business relationship, if you can, the average bank account open for like 10 to 15 years, imagine if you had that, plus you could service everything else that a business needs on the payment side. You would have a very, very sustainable, very, very large business, and that's what got us really excited. If you look at expenses, Expensify is a very big company. You look at Bill.com and the payment side as
Yeah, and more importantly, like we can do that while delivering like a super high NPS to our users. So NPS is like Net Promoter Score. That means like just how much do people like your product. And for most of you that face your bank, face your financial services provider, maybe not your clearing broker or something like that if you're an RIA, but the account that you guys are actually using to take clients out to dinner and pay for your office and all that stuff. Most people want to tear their hair out when they're having to deal with that stuff. So our job in life is to make that a little bit easier.
Yeah, that makes sense. So, Latif, question for you, since you're in the VC space. Like, I don't know how much you can discuss about this, but what are you seeing in terms of what your portfolio companies are doing in terms of their tech spend, what they've done over the last 6 months? I don't know how much of that you can discuss, or are people cutting back? Are they rethinking how they're doing tech, and any thoughts on that?
Yeah, I mean, look, for us, we've got portfolio companies that are doing tremendously well through the downturn. We have many that are struggling because, frankly, early stage companies don't all deserve to, continue to get pumped with free money. But the reality is they all need to be more efficient. So I think people are looking at their burn rate much more closely. So if you can spend more efficiently, that's certainly, we're very much pushing software that allows them to do that. And then people are very focused on headcount. We're not seeing massive increases right now in headcount across the board. In fact, we're pushing our companies to figure out how do you grow and how do you actually reduce your spend. And so free money game is over, and we really push our companies to have like 24 months of cash, and we've been big cheerleaders for Row. We have vested interest, but basically a huge majority of our companies are now using Row and are very happy customers of Row because of the fact that it is a single platform that services all their needs. And so
yeah. And we sit on top of about 1,500 companies. We see all their data as well, or like just trends in the data. And for us, we saw a lot of companies cut back earlier this year, especially on advertising spending. And then over the past couple months, things have started to kind of come back a bit for some. Some have like kind of shrunk dramatically. But then the stronger ones are reaccelerating right now, and we're seeing like investments come in. We're seeing spend go up in a modest way, and so I think it's I think after last year, everybody had to catch their breath for 6-9 months, and we may still be in that moment, but at the end of the day. People that are building real businesses are not going to stop doing that, and the nature of the world is growth, and it's easy to like lose sight of that. I think when you're investing, markets go up over time. Like you get paid risk premium.
And a lot of people were on vacation, seriously on vacation this summer.
Yeah.
There was not a lot of deal activity, but I can tell you in the whatever 6-7 days since Labor Day, it's been pretty crazy. So, there's a bias to action. People have a lot of dry powder in their funds, and entrepreneurs are going to want to build really amazing businesses. And we've seen, if you look at Uber and Airbnb as two of the flagship companies that came out of the last recession. I don't know if we're actually in a recession or not, but the last downturn, we fundamentally believe that there are going to be just generational companies that are built in this period in fintech and more broadly, but certainly within fintech.
Yeah, so I appreciate that optimism. I mean, some in the audience might think, obviously, like fintech it's been a little brutal lately for some companies. I mean, just the public fintech companies in particular, Block and Square, Block Square's down 77%, PayPal's down 70%, Robinhood's down 86%.
Yeah.
A lot of people are wondering, is the fintech thesis wrong? I know you guys are optimistic, but what are your thoughts?
I think it's really about time horizon, right? Those are true from a very, very inflated high. But let's take Square and Block for example. If you bought that IPO in 2015, right now you're sitting at like roughly 7x your money, and so that's pretty good over whatever 7 years. And I'll tell you guys a bit of a funny story, maybe not funny, but an interesting story, which is prior to being at M13, I was running investments for Virgin in the U.S. And in 2011, we made a Series C investment in Square. It went public in 2015, and we were up like 3-4 times our money. The lockup had expired, and there was a discussion on, research was a little bit bearish. There was reasons for liquidity, and so we sold our position.
And that was when, like
2015-ish.
Okay.
If we had held that today, that'd be worth 10x versus 3x. If we had sold it at our peak, if we were that smart, we would have made 30 times our money. So I think the lesson is like, these are long duration markets, and if you're building foundationally good businesses like Everett is building, where you've got diversification of revenue, diversification of customers, those are good businesses to just hold for the long term. So that's kind of how I view it.
I always think about it as like, look, like if we're building this company, we're growing really fast. We're taking market share from traditional financial services as well as continuing to grow that market pie. And if you're a high growth company and multiples come down like a bit, it just means you need to wait another year to get to the market or whatever, and you outgrow it. And that's sort of the great thing about being in private markets. We're not. We don't have to come to market every single day. But even if you're a public market investor and you're looking at companies that are, have that growth profile, if you believe in that growth profile and you believe that the founders or CEOs of those companies can sustain it, you are investing in a long duration asset. Equities are an infinite duration asset, and and I think in tech especially, it's mostly deferred revenue, right? And a lot of tech companies are not profitable because they are building growth, but that growth, if they slow down on that, in theory, generates cash flow. And so I think you kind of have to make sure that even though it's a liquid product, it's a liquid stock, that your time horizon matches that of the people whose shares you're buying. And I don't think we had a lot of that in 2021, by the way. I think we had a lot of people that were piling into stuff, hoping to sell it 3-6 months later, at a triple, which is great when that happens. I've done that before, but generally speaking, that's not the horizon of the folks that you guys are investing in.
Yeah.
So do you think, in some ironic way, because prices are down, people are now thinking more long term than they were thinking possibly last year and years prior?
I think I think retail is. It's hard for retail to think long term a lot of the time. A lot of it does, but the fast retail money, which markets are made at the margin, and that was the marginal buyer in 2021, right? That's it's. They're generally not in the market to do that, which is okay, by the way. A market, that's how you make a market. But I think people need to be thinking long term now. Generally speaking, you're buying in it, at valuations that are back to sort of now below sort of where we were historically, but before they were above. I think you need to I think it's really hard to bet on what's going to happen over a month, a quarter. I don't know if we've hit bottom or not. I don't think anybody really knows. But if you're invested in companies that you believe are going to continue to grow, it's fine.
If you actually look at multiples, so they've gone from 15x to 5x broadly in fintech. But if you actually break it down, consumer fintech has gotten hammered, and that's not surprising. Consumers are very fickle, and so Robinhood and Affirm and then Klarna in the private market, they've all been pretty hammered. If you look at B2B, where Everett is playing, those have not been as bad. They're down 50, 60%, but then a company like Bill.com, which has been around for 10 years, still growing 80% year over year. It's got great software margins, 70, 80%. They trade at 25.
What's that? Even though we're beating them in the market.
Yeah, and Everett has a much better product.
But they set the pace a little bit. They're a couple years ahead of us. But the 25
times revenue still, so that's a premium valuation.
Yeah, and it's because people believe in the story, right? They believe that they're going to keep growing 80% a year, which I kind of do too. Again, we'll take a piece of that, but the market is so big and it's so difficult to win in. And once you start winning, we've raised $105 million, which is a lot of money, but we're competing against companies that have poured billions of dollars into product, and we're winning against them every single day. And it's because the B2B space is so it is so complicated, and it is so big, and it is so archaic. We're still using tools that we didn't, it's still paper for the most part, or they're derivative of paper, which is Excel basically.
Yeah, so we've been comparing, 2021 to today, and so obviously a lot's changed in a year. So, Latif, when you're looking at, new fintech companies and making new investments, what factors are you focused on today compared to what you would have looked at maybe a year ago, or has that changed at all for you?
At the fundamental level, it's the same. Big market, founder who is building for the right reasons, has got a unique point of view, and what we think is going to be a pretty durable business from the way they're thinking about their business strategy and their revenue model. I would say the one thing that is clear is owning your infrastructure is going to be really important. So there's been a huge trend in banking as a service where you're basically building on the backs of other players. And frankly, when Row started, they had to do that. And what they've done really nicely is, they've really built their own infrastructure. So what that allows you to do, if you own your own database, you own your own ledger, you can just move faster and build non-commodity products that aren't using the same parts that all the other competitors are using. And so Stripe is another great example of a company that just owns all of their infrastructure. So we think banking as a service and neobanks and that whole market is probably seeing its best days ahead, and you've got to, it's almost like the opposite of asset light. You need to own all the stuff in order for you to really, build something that's going to, break through the clutter. And then the only other one I would say we're very bullish on crypto and Web3 as a firm. And so what is a nice combination of financial services that are leveraging crypto as this very big, source of wealth, over $1 trillion asset class now. 45 million Americans own Bitcoin. When is the financial services world going to kind of embrace that versus actually not giving people credit for the fact that this is actually something that over 12 years now is shown to have value? So we think that's a very interesting theme.
Yeah. So Everett, question to you now. Have you changed how you're marketing Row, given what's happened in the last year? How you're trying to acquire customers? I mean, are you guys trying to focus on other things compared to what you had done last year?
Yeah, I mean, a little bit. Yeah, we recognize that what we're doing right now is probably more topical than ever. And it's not just marketing; it's building as well. So we spent the past we launched our expense management product in the middle of this year. Having been building that for I guess almost a year, and on the same track, about a year of work, have been building out more advanced treasury management products and securities-based treasury management products, so that corporates can help manage against inflation, help preserve their assets, because we know that takes its toll. It's very real. Companies aren't necessarily don't get capital to put it to equities or make bets on other things, but they should still be protecting their purchasing power. So that's something we've been thinking about for over a year.
Brett, what kind of yield can you offer these guys if they move their cash over?
I mean, we try to keep it simple. We do T-bills and corporates, and we have an advisory business. So if you guys have corporate clients that want a full stack platform, we should talk. But but overall, like, I think it's about it's not about like changing we haven't changed too much, but we are marketing more towards control because we hear that every single day from CFOs that we're talking to. And I know, as having run Row and before we had our product in the market, and we're running out on ourselves, it's really hard to know like where you're spending and where your money's going, and maybe like 15 days later after your accounting closes. But actually having real-time pulse on that is tough. So I think it's like we've seen a lot of inbound demand as a result of sort of that marketing of driving control over finance.
Okay. Yeah, thanks guys for answering all that. We're now going to go to questions from the audience. So I think a lot of people have a lot of questions about this. So we'll just go. First one here. What are the other geographies where you guys are considering fintech?
I can answer. I mean, so we operate only in the U.S., but I do some angel investing, sometimes in conjunction with our investors. I've invested in 3 Rows for X, one in Brazil, one in Egypt, and actually 2, but those 2. I think emerging markets are really interesting, like, because you have a leapfrog effect where fintech can be a first mover as opposed to coming after traditional financial services, and you get that right, it goes really fast. One of our investors, Dragoneer, is kind of the main investor behind Nubank in Brazil, which is a great story and a great sort of example of that. So I think Brazil is a really interesting market for this type of stuff, in my opinion.
I just got back from Mexico City, where for us, like, we are predominantly investing in the U.S. We are going to do more international, and Mexico is obviously close to us, a very big market, and culturally actually feels much more American than, say, like Brazil, which is very, very different culturally. And so there's a really interesting VC community there. I mean, you could build a $10 billion company just servicing Mexico City, given their population growth. And so that's an area we're looking at. We're looking at some fintech and some commerce companies right now in Mexico.
Okay, thank you for that. Next question: what kinds of heads and/or tailwinds do you think fintech specifically is experiencing that other tech sectors are not experiencing?
That's a really good question. Whoever answered that, asked that. I mean, I think fintech, like, we're not alone in valuation compression is real. I think headwinds that we're facing are, it depends on what. Fintech is a really broad category, so it kind of depends on what you're doing. And I think if you're primarily, if you're highly dependent on cost of capital as a fintech, and a bunch of fintechs are, you're facing really, really severe headwinds. I think if you're primarily software and primarily driving, efficiency, I think you have tailwinds.
Yeah, I mean, we were talking earlier, if your whole game is like cost of capital arbitrage, you're probably going to end up losing. So that wouldn't be good. I think it comes back to what I was saying earlier about like owning your own infrastructure. Like, most of fintech is built on the backs of partners, and I think that is just really, really hard to get to gross margins, because everybody needs to take a piece of that margin, and it's ultra competitive. So it's a massive market, and there will be, even in Row's specific space, there's 2 or 3 other well-funded competitors, and they all will become, we think, huge companies, just like Row. But it's incredibly competitive, and so I think the headwind really is like, how do you not just become a commodity?
Yeah. I think the other thing that is really important, that could either be a headwind or tailwind, depending on how you played it over the past couple of years, is like compliance and regs. If you invested in we brought on our first GC 2 years ago, but if there are a lot of fintech companies that sort of took a, when the regulator calls, we'll figure it out approach. I wouldn't recommend that. And regulators are very serious about this space, especially given, I think last year there was, a good amount of lapses, honestly. And so if you're prepared, it's honestly a competitive advantage if you have a real chief compliance officer, legal team, et cetera, and you do things the right way. If you don't, I think you're going to be stuck for a while. I've seen that happen with a bunch of fintechs where all of a sudden innovation freezes because all they can focus on is getting back to being compliant.
That makes sense. So I don't know if there are any other questions. If not, I have a follow-up for you. So talk about owning your own infrastructure, right? So a fintech company doing that. So are you recommending like that if someone's building a fintech company, they should try and kind of integrate as much as possible within their business?
I mean, yes, it's hard to do that right away. It's expensive. How much did you raise? 100?
Yeah.
100, like you need to raise.
Don't do it at first.
Yeah, you can't do that right away. But I think as we're thinking about, is that the mindset of the entrepreneur in terms of like how they are thinking about the business long term? And once they raise their, seed, Series A, Series B, they continually invest in that infrastructure. I think that's really important.
Okay, we have another question here. Is there a difference in the current dynamics and opportunities between early stage fintech versus later stage fintech?
I mean, I think in late stage fintech, it's pretty tough. Like it's hard to have an edge. You're investing, late stage fintech companies look very much like public companies. And so, there probably is an opportunity now. So take Klarna, for example. I think they were a $46 billion company who then had an 80% markdown, and Sequoia and other great investors came into that round. That's a great opportunity to buy a business based out of Europe that had real scale. So if you can get involved in those types of kind of special opportunities, that's great. But generally, I think late stage investing is quite tough. It's very, very competitive.
We're a late stage company. I mean, it's or later, but I mean, it's more about like it's different, right? It's like you are more exposed to the market, kind of, right? Because you're that much closer, so you need to think about that.
Yeah, you start to think about Rose. I don't know how many years from whatever they're planning.
Depends on how you define late stage.
But you're suddenly looking. But we look at Bill.com's multiple at 25 times. We feel like we'll be all right.
But yeah, I think it's earlier, I always think about it as like, from early to late, you're moving down the income statement. So it's like really early is like maybe off the income statement, and it's like growth, right? It's users, stuff like that, things that are more esoteric. And then you come to like top line revenue, and then you get a little bit bigger, and you get to like net revenue, and then you get a little bigger, and you get to gross profit, and then you get maybe you go public, and you're, like forward earnings, and then at some point you're, trading on a PE, and that's sort of, I think, like the value chain of early to late, whether it's fintech or something.
Early stage is fun. You're basically making bets on people. And
you're not going to come to market for like 10 years anyway, right? So it's like the market today is kind of...
Yeah, the market today is kind of irrelevant to that early stage company.
Okay, so I think we have a little bit over a minute left, so this will be the last question. What is your advice for those starting a fintech startup in the United States?
Everett?
Talk to Latif, obviously.
If it's a good idea, come to me.
Best investor, best board member in the world. I mean, I would say like just really make sure you're solving a real problem. Like honestly, I think there are a lot of companies that came out again over the past couple of years that were not fundamentally solving a problem, like really a financial services company with a little bit of tech. So I would say make sure you're solving a problem for your users that is not already solved by current services. And if you do that, fintech is a great place to be because you can really build your monetization in a way where you're very aligned with your users and are solving, some of the hardest problems for them. But I think the flip side of that is like, if you're purely like, again, more fin, less tech, I think that it's tough and it gets very competitive very fast.
That's a great answer to finish on. So thank you guys for your time. Thank you everyone for coming out to listen. So
Thank you.
Everett, Latif, appreciate it.
Thanks.
So
Thank you.
everyone.